Welcome back to the grand finale of Punjab National Bank presents Times Network India Growth Mission. We've been talking about India's recovery, rapid recovery after COVID-19 and the lifting of restrictions, and then the headwinds which have followed. The question today is how resilient are we compared to the rest of the world? Can we emerge stronger at a quicker pace? To speak on this, I'm joined today by Naina Lal Kidwai, Senior Advisor and Member, Board of Rothchild Co India, Krishnamurthy Subramanian, Professor of Finance ISB, and Atul Kumar Goel, MD and CEO, Punjab National Bank. So, Dr. Subramanian, let me begin with the basic question that I think economists, experts, those in industry and corporate India are asking themselves now. We're facing this inflation headwind that the world is facing, but we know it hits the poorest of poor perhaps harder here in India. Is India going to manage to tide this over with measures like the ones we saw where excise duty were cut, or is much more needed, sir?
I think first point to note, Tamanna, is that while people are talking about double-digit inflation, that inflation is in the wholesale price index, which is not what the consumer faces, point number one. It is the consumer price inflation that the consumer faces, which certainly in the last couple of months have been a little higher, and that is the one that monetary policy tracks as well, but 7.5%. But I think this has to be seen in a global environment where the United States, with typically had 2% inflation, now is facing 8% plus inflation. It's a 40-year high. The United Kingdom is actually at a 30-year high in its inflation. Germany, 26-year high. Other countries, emerging economies, just copy-pasted the Keynesian demand priming that the advanced economies did. You have Turkey at 70% inflation, Argentina at 60%, Brazil at 12%. In that landscape, if you look at India, actually has fared much better, and certainly measures are being taken as well. And you saw how the excise duty cuts have been done. Now, I think what has to be followed up is basically states. I'll give you some examples. If you take Maharashtra versus Gujarat, actually on the value-added taxes, VAT on fuel. Maharashtra actually charges about 31 rupees per liter, as overall state-level taxes. In contrast to Gujarat, just 12 rupees, and that is what explains 112 versus 96, for instance, the retail price of petrol in Maharashtra versus Gujarat. West Bengal, 26 rupees per liter, while a neighboring state like Assam, 12 rupees. If you take Rajasthan and compare that to Uttar Pradesh, Rajasthan charges 27 rupees a litre, while Uttar Pradesh at 15 rupees. Now, these are just 3 states that I've highlighted. There are a few more as well. States need to follow up, and actually these are the states that have not cut even much at all. The first cut happened in Diwali last year, and then there has been a follow-up cut as well. I think the states need to clearly look at the data. I think all of us consumers and economists are able to see that the data clearly shows that these states have not backed up the rhetoric that they actually use in actually giving a leeway to the consumer on the petrol price. So they need to back up and actually walk the talk.
Mr. Goel, let me take that point to you. We're facing tough times for sure. What do you think is going to be the impact of inflation on demand and the kind of recovery that we had started seeing post-COVID-19?
It is a very good question. As far as inflation is concerned, in my view, last 2 years was very challenging on account of this pandemic issue also. And this pandemic issue was not only in the India also, it was the global phenomena. And after that pandemic also, this geopolitical tension between the war of the Russia and Ukraine, that is also impacted the inflation also. If you see the inflation is on account of the supply side. If you see the supply side, as I told you, it was impacted last 2 years on account of the COVID, and it has been further impacted on account of this war between the Russia and the Ukraine. And demand is increasing, supply is disturbing. So I think this is the one major point for the inflation. Both are the opposite side. supply side, there is a less supply, demand is increasing, but as far as impact of the inflation is concerned in the India, it is not in the India, it is the globe also. If you see the data of the inflation, it was 7.79 in the April, although it was much higher as compared to the last 8 years, and wholesale price also more than 15%. But as far as India is concerned, India is very well placed as compared to the other country. We do not see much challenge on the growth side on account of the inflation, because now demand is increasing. We have reached to the pre-pandemic position also, and RBI has also taken the timely action for increasing the 40 basis point in the repo rate, and on account of the price which was due to the increase in the petrol price or the diesel price, which were impacting the transportation, the government has also taken a reduction in the excise duty, because the inflation is on account of the two. What is the food inflation? The another is the on account of the oil price. The oil price on account of this cut by the government of India excise duty, it will be settled, and monsoon is very good, and moreover the production is also very on higher side, but production price was increased due to the transportation cost. But by reduction of this excise duty, I am hopeful that it will be stable in times to come.
Let me come to the broader question of where the economy is heading, and let me come to Naina Lal Kidwai on this. And of course, inflation is a big part of it. But we're talking about it in the context of the India growth mission, something which the world has been very bullish about. And then you've had a series of events starting this calendar year. You have the Russia-Ukraine war, you have a recovery which is still ongoing post-COVID-19, and then this inflation wall hitting us. Ms. Kidwai, do you think India will be more resilient versus other nations in overcoming this? Or in your view, what are the biggest challenges that India will have to face?
Look, we are already seeing scaling back of the GDP expectations there were for India. But exactly as Mr. Subramanian says, we have all countries facing similar issues for similar reasons. And there is a scaling back across the board, where India still remains on the top of the heap. So we can get a little but small comfort from that. Is GDP slowing from what we expected, from the 9%, now talk more of the 7, maybe even 6 in some cases? I fear that is indeed the case. There is a lot of talk of stagflation, maybe even recession. I'm here in the United States, and things are quite worrisome here, as we see, both in terms of joblessness, inflation, and indeed growth rates. A slowing China is a given, which also impacts the rest of the world, where China's GDP has scaled back enormously, as we well know. So we have to be able to live with what is probably not the bounce back we expected. Managing inflation is key, but not easy, because much of it has to do with external situations, particularly our fuel bill. Can states do a better job? Absolutely. To see that scaling back of the VATs and supplementary taxes for some of the states is certainly a way. There is also the food issue, and I think India has done well to scale back on wheat exports as we look at our own food inflation. But I do think we need to focus on our own internal supply chains and the food discussion, because India is fairly food dependent on itself, and ensure that we can at least curtail the consumer price index to the extent that food impacts so many, particularly those that are the most needy.
Dr. Subramanian, let me take that point to you. We're a consumption-driven economy. It's expected and projected that inflation, and yes, you're right, it's WPI in the double digits, but the CPI is not a pretty figure either, as I'm sure you will agree. The fear is that this is going to hit discretionary demand the most. This is going to hit perhaps our services. Now, how do we tackle this problem where consumption and the propensity to consume was just beginning to sort of come back post-COVID, and then we've been hit with this blow?
Tamanna, I think we have to be very careful to not be inconsistent. You know, your first question to me said that inflation hits the poor the most. And then now you're asking me about discretionary spending. You know very well that discretionary spending is done by the rich. Who actually have had savings over the last, during the COVID period for sure. So I think either it's going to be the poor hit or actually discretionary spending hit. I think, both can't happen simultaneously. They're internally inconsistent. I think point number one. Second point is, I think especially now with the Atmanirbhar Bharat emphasis, I think that overall India is depending far more on internal demand. In fact, actually, and this is the other point I wanted to mention, a recession in the United States and China slowing down, especially because of the lockdown policies, I think would be something that may actually be on balance, may be good because that will reduce demand, global demand, and thereby, lower inflation. If you see some of the commodities, whether it's iron ore, cement, steel, some of these actually are down about 40%, some of them 30 to 40% from their peaks over the last 12 months, which is actually also indicative of some of the demand coming down and the fact that, going forward, these recessions in these countries will reduce demand. So given the fact that we have emphasized, and I must highlight particularly the way we basically went about our fiscal policy during the COVID era, very different from the advanced economies and other emerging economies, actually positions us well, much better than other countries to bounce back once this inflation aspect is receded. Last point, and this is something which I will highlight, the Reserve Bank has to actually walk a very tight rope, recognizing that when you look at, when you change the benchmark rate, which changes the lending rate, there is a difference in the impact that it has on consumption versus the impact it has on investment. Of consumption, for instance, food consumption does not depend on lending at all in India, unlike in the advanced economies. It is only durable goods consumption like, a car or a motorbike or basically housing demand. That is the only thing that is impacted through the monetary policy. Investment demand, on the other hand, is affected significantly more. And another reality which we have to keep in mind, monetary policy makers especially, is that when there is a monetary tightening, our banks pass over the increase in the benchmark rate immediately to the borrower. But when there is a monetary loosening, they do not do so. And I think this is something that has to be kept in mind because that has an impact on investment, especially during the tightening versus loosening, because growth, remember, actually, and that has been the emphasis, will happen primarily through private investment, which monetary policy has to be cognizant of.
Let me come specifically to that point of rate hikes that Dr. Subramanian also spoke about and how it can impact retail loans. Do you see that impact taking place, especially in the home loan, auto loan, personal loan kind of category, or do you think that business loans can also be hit?
Already 40 basis point rate was already increased. If you ask my view, what is my view on the interest rate outlook, still I am of the view. In times to come, there may be a further hike of the 40 to 50 basis point. This is my personal view because that is the view of the others also. As far as your question is impact on the retail loan or the auto loan or the business loan is concerned, because all the loan are basically linked to the external benchmark as on date, personal loan, housing loan or auto loan. So impact definitely will be increased by 40 basis point on account of increasing of the repo rate. And if I see the further rate of increase by 40 to 50 basis points, definitely, in my view, the loan will be increased. Interest rate will be increased in the loan, definitely. But because demand is good as on date in retail loan also, because we have reached to the pre-pandemic level, demand will be there, but definitely rate of interest will be repriced on all the loan.
Kidwai, I want to come to you and get your perspective from the point of view of business, large businesses or even medium and small businesses who have been dealing with a rapid increase in input costs. They've managed to pass on some, but not all. What do you think are the challenges up ahead for them, and how can this be mitigated by policy?
So it's pretty clear in today's environment that input costs have soared very high. Yes, there's been some scaling back, as Subramanian mentioned, in terms of any slowdown happening in the US and China, and we do benefit from that. But the fact is these input costs are still very high. And as long as that remains, initially companies did not pass on price increases because they were still very vulnerable and wanting to keep demand up. But the need to pass these on to consumers is very much there and beginning to happen. And that indeed is also what causes inflation and then demand to begin to drop. So this, I think, is a scenario that we have to expect where either because of volatility of the supply chain or because of shortages, because commodity prices are soaring up, we have seen part-time disruptions because of the Harakiri lockdown in China, where we found containers and ships all stuck there, or things which look like they will stay around for longer, like the Ukraine-Russia war. So with all of this, I think we are in a situation where input costs will be high. Fuel costs underpins everything because it's logistics, inputs into every industry. So with this, I do fear that at a minimum, companies' margins will come down. And it is possible that the high growth that many have seen going back to the pre-COVID time may also begin to flatten. And this is not an easy time for industry. Then you couple it with higher interest rates, which is a given. So borrowing costs go up. That has its own impact again. And investment cycles begin to change. So the cycle we're in right now is a tricky one, and not one that we can say with complete comfort that we are going to see the high growth we were hoping for even 6 months ago return, unless we see input costs coming down, the interest rate environment that goes up, slowly it will, but not maybe sharply as we are fearing right now. And the investment cycle, which was beginning to build up, actually strengthens into a wave rather than beginning to hold back, because it is looking, watching and waiting to see exactly how this all plays out. I think, in the US right now, there's still an expectation that the markets come off by another 10%, as in global and US markets. Europe, in any case, weak. All of this impacts sentiment in the India market too. And if our markets are on a cycle where they're coming off, it's not an easy environment, and it's volatile, as we've seen through the LIC IPO, where we can continue a disinvestment process, which we were also banking on. The M&A disinvestment process may still move ahead, but certainly anything envisaged in the capital markets is not going to be easy in a market such as this.
So if I were to ask for a sort of a concluding remark looking forward, and let me begin with Ms. Kidwai. Clearly, a lot of factors that are impacting us are not in our control. These are global factors. What can India do, or how is India uniquely positioned to mitigate these concerns?
So I wouldn't say a rough ride. I think rough is what we had 2 years ago. But the sad part of it is what we were hoping for, which was a golden ride, is probably not going to be golden, simply because there are going to be a lot of constraints, as we've been discussing. So we will see growth. GDP will move up to, definitely people are talking more like the 7%, which is by no means small. So we will actually benefit from being one of the economies that is seeing growth in the world, but not necessarily at the level that we were hoping. And the rough ride is really more at the immediate level of inflation, which, if managed properly, at least in terms of the bottom of the pyramid, is something which would smoothen what could otherwise be very difficult for a lot of people. But I think I'm hoping that this is really, short-termed, as in some of these volatile issues and input cost issues. And if we can indeed solve for green energy and all of this, which we have embarked on, so well over the past few years, maybe we can weather the fossil fuel storm by looking at all the new things that we have put into place, and indeed the green hydrogen projects, which are now well on track.
Tamanna, I actually will offer closing remarks by not being as pessimistic as some of the others, in the market and elsewhere may be. As I already mentioned, some of these commodities, which are inputs, have come down compared to their peaks. And given the prognosis forward for the US economy to go into recession, maybe Europe as well, and China, I think demand will come down. And if demand comes down, actually that will help inflation. As it is, I think, India will be the fastest growing economy and will possibly have the lowest inflation, even though on an absolute level, it may actually be, 6% plus, maybe for a few months, but will have the lowest inflation among, in a relative sense. Do remember that, in the previous crisis, and that is without any supply side disruption, global financial crisis, we had 17% inflation, average 13-14% inflation. That is what we've come through. So compared to that, India is doing, much, much better, while the advanced economies and other emerging economies are doing much worse. And this is the message that investors must take, that in a relative sense, exactly the way you asked, compared to other economies, both on GDP growth and on inflation, I think India will do well because of the headroom that we have earned ourselves from very prudent, policy during the COVID period. Last point, I think, and I'll emphasize this very, very importantly, is that while there are a lot of commentators who are basically, calling for more rate hikes and et cetera, I think it is important for the monetary policy makers to take into account the facts that I mentioned, which is that, banks will pass on the rates during the hike and, will not pass on as much when the same 1%, if that is what is, in mind, is brought down. As a result, at the end of the cycle, we'll basically be looking at higher lending rates and thereby lower investment. And I think in the previous cycles, the investment declined significantly, and this is the point I want to mention. If we have to have growth happening, investment is something that is extremely critical. And my last message for the private sector would be that once the war stops, and I think I'm not a war expert, I think others may be able to say, well, investment will come back. It is the uncertainty of the war that is holding back investment, and I think we know very well investment, because of the gestation periods, typically is impacted far more by uncertainty. So I think the private sector should prepare, lay the foundation for as soon as the war stops to basically start investing, so that they actually can decide how much the uncertainty will be gone. So I think that's what I would leave as the message. Cautiously, looking forward to the period in a relative sense for India, both on GDP growth and inflation compared to the other economies.
When there was a reduction rate interest, it was not passed. So I do not agree with this view. There was a transmission of the rate of interest to the borrower also. If you see in the last 1.5 years, there was a reduction more than 150 basis point in the across all type of loan. But as far as a rate hike will be there, so definitely the price of the loan will be high. But if your specific question, how you see the country as compared to the others, I am very optimistic. I think there will not be very impact on our economy, because now every country is seeing to our country. for their any demand also. So although there is a little bit cut by the RBI also in the last monetary policy of the growth rate from the 7.8% to 7.2%, but I am very optimistic. Definitely in the current environment also the growth of the Indian economy will be definitely between the 7 to 8%.
India is one of the fastest growing economies in the world. It's a massive marketplace. It has an aspirational population that wants to work hard and do more. And hopefully we'll emerge from what the world is suffering much stronger, at least in relative terms. I want to thank all of you for joining us in the discussion today.